Welcome to the Deep Dive. We're here to cut through the noise of earnings season, especially the complex financial reports, and really bring you the insights that matter. Today, we're taking a close look at Cohen Company's Q2 2025 earnings call. And, well, what a quarter it was. We're going to unpack how this firm isn't just, navigating the capital markets, but seems to be actively transforming itself, particularly with a pretty bold push into the crypto space. This deep dive is really for you, to help make sense of these strategic shifts and, what they could mean for Cohen & Company's future path.
Yeah, it was certainly a period that grabbed our attention. It offers a fascinating glimpse into a financial institution that's really in the middle of a significant strategic pivot. We'll explore how their investment banking arm ignited this dramatic turnaround, what their sort of rapidly expanding SPAC ecosystem means for their longer-term vision, and also the market reaction, which was, well, a bit nuanced, wasn't it?
Definitely nuanced.
It's a story of traditional finance making a decisive move into new, pretty dynamic territories.
Absolutely, it's a compelling narrative. So let's dive right into the core numbers for Q2 2025. Cohen & Company reported a GAAP EPS that's generally accepted accounting principles earnings per share of $0.81. Now, it's a substantial and, frankly, incredible swing from a loss of, $1.47 in the same quarter last year. You can see the turnaround immediately.
Right. And that turnaround becomes even clearer when you look at their non-GAAP figures, which, management really emphasizes. On an adjusted pre-tax basis, income per diluted share came in at 94 cents. This non-GAAP figure, it often gives a clearer picture of core operational performance, right, by stripping out certain one-off items.
It gives you a better look at the underlying health.
Exactly. And it represents a really significant return to profitability after that adjusted pre-tax loss of $8.6 million in Q2 2024. This isn't just a slight improvement. It's dramatic.
Dramatic is definitely the word. Their revenue numbers absolutely popped this quarter. I mean, we're talking a massive 455% jump year over year. Total revenue soared from $10.8 million last year to an impressive $59.9 million. That's not just growth. That's like an explosion on the top line, which, directly translated into a net income attributable to Cohen & Company of $1.4 million. So for you, tracking this, it means they're generating real cash flow again.
And to cap off what was clearly a very strong quarter for shareholders, the board also declared a quarterly dividend, $0.25 per share. This action isn't just a payout, it reinforces their commitment to returning value, even as they're pursuing these, ambitious growth strategies. It's a sign of confidence.
Okay, right. Let's unpack this a bit more. That kind of revenue explosion doesn't just materialize out of thin air. What really fueled it? The primary engine, the powerhouse behind these numbers, seems to be their full-service boutique investment bank, Cohen Company Capital Markets, or CCM. They generated a stunning $37.4 million in new issue and advisory revenue across 25 different clients.
Yeah, and CEO Lester Brassman specifically highlighted their strong momentum and robust pipeline heading into the second half. That suggests sustainability, not just a one-quarter wonder.
Right.
What's truly fascinating here, I think, is this concept of a transactional flywheel that Cohen & Company seems to be, perfecting. CCM's fee-rich advisory services, guiding clients through deals, capital raises, that generates significant capital.
Okay.
And this capital isn't just sitting there. Cohen & Company then strategically deploys it into other complementary areas. Think about their growing SPAC initiatives, which we need to talk more about, and their trading desks. It creates this self-reinforcing cycle.
Success in one area feeds the next.
Exactly, where success in advisory generates capital that funds growth in SPACs and trading, which in turn might generate more advisory opportunities. We've seen similar models, maybe less integrated, but they seem to be building something quite robust here.
That does sound powerful. But playing devil's advocate for a second, does tying advisory fees so directly to principal investments, especially in volatile areas like SPACs, introduce new risks? I mean, what happens if the market sours? Or the SPAC market itself hits a rough patch? Does that flywheel grind to a halt?
That's a very fair point, and it's the inherent risk, right? The efficiency in good times can become a drag in bad times. However, they seem to be trying to mitigate some of that, partly through diversification of the types of transactions, but also by leveraging insights from advisory to make smarter principal investments. And speaking of reinvesting that capital, look at their newly launched SPAC-focused equity trading desk. That's a direct example.
Right. The trading desk.
Active early in Q2, it generated over $1.4 million in trading revenue in its very first quarter. That shows pretty rapid monetization of their expertise in that specific space. It's complementary to CCM.
So it's not just advising on SPACs, but actively trading around them too. That makes sense. And principal transactions and other revenue also kicked in significantly, right? Yeah. $9.5 million.
Correct. And that included $6.7 million in gains on what they call principal investments, which are, like you said, directly related to those CCM advisory services and their broader involvement in the SPAC market.
Explain principal investments a bit more. It's not just cash fees.
Exactly. Often, instead of just cash, they might receive financial instruments as part or all of their compensation. Think warrants, convertible notes, maybe even founder shares in a SPAC. The clever part is these instruments then have the potential to appreciate significantly if the underlying deal or company does well. It lets Cohen Company participate more directly in the upside of the deals they structure. It feeds that flywheel we talked about.
Okay, got it. Now, what really caught my eye in this report, and I think yours too, was Cohen Company's deepening commitment to its SPAC ecosystem. This feels like a major strategic shift, doesn't it? In June 2025, their sponsored SPAC, Columbus Circle Capital Core I, entered into a business combination agreement, a BCA, with a company called ProCap BTC.
Yeah, this isn't just another deal on the pipeline. It feels pivotal. It really underpins the strategic transformation we're seeing. ProCap BTC, you see, is a Bitcoin-native financial services firm operating right at the, cutting edge of digital assets.
Bitcoin native, okay.
The merger is expected to close by year-end. And what's critical for Cohen Company is they're set to retain 2.1 million founder shares in the combined entity. Upon closing, that new company will operate as ProCap Financial, Inc. And here's the kicker. It aims to hold up to $1 billion in Bitcoin on its balance sheet.
$1 billion in Bitcoin. On the balance sheet of a company they'll have founder shares in.
Precisely. So think about that. A traditional, respected investment bank suddenly gaining a direct, significant stake in a firm holding potentially massive amounts of Bitcoin. We're seeing a traditional firm strategically repositioning itself, potentially inheriting a kind of crypto premium that the market might not fully grasp yet. And this raises a huge question for you, the investor. What does a traditional capital markets firm owning such a stake in a crypto-native entity actually mean for its future valuation?
That is a huge shift. But okay, let's push back again. Devil's advocate time. The potential crypto premium sounds exciting, sure. But Bitcoin, the whole crypto market, it's famously volatile. Insanely volatile sometimes. Is Cohen Company, as a relatively traditional investment bank, really prepared for that kind of asset volatility hitting its P&L, even indirectly through founder shares? What are the risks if crypto tanks?
That's the crucial question, isn't it? And it speaks to the calculated risk they're taking. They're not just passive holders here, it seems. They appear deeply involved, leveraging their capital markets expertise within this new entity. The idea isn't just to ride the Bitcoin price, but to build a robust financial services firm around it. And remember that SPAC-focused trading desk we mentioned?
Yeah, the one making $1.4 million already.
Right. That indicates more active monetization from their SPAC involvement, not just waiting for founder shares to vest or appreciate. They're building infrastructure around this new direction.
Okay. Moving beyond the big numbers and the crypto angle, there was also a significant operational change, right? JVB Financial got rebranded.
Yes. In July 2025, JVB Financial became Cohen Company Securities. It might seem like just a name change, but it's likely more than that. It signals, I think, a consolidation of their brand, a unified front as they expand their coverage and market presence.
Makes sense. Streamlining the message.
And it comes alongside a big talent push. They've added 18 professionals across sales and trading and technology over the last 18 months. That's a serious investment in people, bolstering their distribution, their execution capabilities, basically getting the team ready to handle this increased volume and complexity.
They also showed some pretty disciplined capital management this quarter. They repaid $2.6 million of senior promissory notes. What does that tell you?
That's a really positive sign for their balance sheet health. It strongly suggests a focus on reducing leverage, which is always prudent, especially in potentially uncertain rate environments. It strengthens their foundation and frees up capital for those strategic growth areas we've been discussing.
And speaking of streamlining, they're also actively trying to sell their remaining 3 legacy Alesco CDO management contracts. What are those and why sell them now?
CDO is collateralized debt obligation. These are complex debt packages, more prominent before the '08 crisis. Managing them means overseeing older, likely less liquid portfolios for fees, so selling them off. It indicates a strategic winding down of these older legacy asset management bits. It cleans things up, it simplifies the business, reduces exposure to maybe less predictable revenue, and lets them laser focus on growth investment banking, SPACs, and definitely these new crypto-adjacent ventures, pruning the old to grow the new.
Okay, so with all these shifts, strong numbers, how's the stock actually performed compared to the market?
Well, as of mid-September 2025, Cohen Company shares have seen really impressive gains, up 43.6% over the last 3 months, and a solid 33.3% over the past year.
Wow. Okay, how does that stack up?
Well, put it in perspective. The S&P 500, SPY, was up about 9.6% over 3 months and maybe 15.8% over the year in that same period. Even the broader broker-dealer industry ETF, III, which has done well itself, up about 43% over 1 year. Cohen is right there or slightly ahead recently. It indicates a favorable industry backdrop, sure, but Cohen Company seems to be leveraging it exceptionally well. Their specific actions look like they're driving real alpha.
Given that strong performance, you might expect, really specific forward guidance. But management didn't give quantitative numbers for revenue, EPS, or margins.
And that's probably sensible, actually. Capital markets can be choppy, unpredictable, especially for advisory and transactional work. Better not to overpromise. However, CEO Lester Brassman did convey a very bullish tilt, was the phrase used, I think, emphasizing a pipeline-driven inflection from banking and advisory, plus those new SPAC-adjacent trading revenues. And this confidence comes even as we're heading into, seasonally choppy September, though markets are still near highs.
Right. Now, the market reaction on earnings day itself was a bit odd, mixed. Shares closed down 3.7% for the open. What do you make of that?
Yeah, you have to look closely there. It reflects the tricky liquidity dynamics of a microcap stock. While it closed at $11.56, down from the $12 open, that closing price was still up 4.57% compared to the prior day's close.
Okay, so up day over day, but down intraday.
Exactly. And trading volume was really light, only about 3,675 shares. With microcaps, low volume can amplify intraday moves both ways. It suggests investors are maybe still processing this complex story, balancing the great results with future execution risk rather than a flat-out rejection of the earnings. Low float means higher volatility sometimes.
Okay, so looking ahead then, for you, the listener, what are the key catalysts that could really drive Cohen & Company's performance? And conversely, what are the risks?
Well, on the catalyst side, the big one is the potential closing of that ProCap BTC de-SPAC transaction by year-end. That feels huge. Continued strong performance from investment banking mandates in the second half, more monetization from that SPAC trading desk, and just consistent dividend declarations. Those are all key positives to watch. But you absolutely need to consider the risks. That multi-pronged capital markets focus offers great upside leverage, but the microcap nature, that low float, brings liquidity-driven volatility. And external factors always matter: overall market activity and issuance and advisory, investor risk appetite, especially for SPACs and crypto. Those frame the near-term picture. High reward, potentially higher risk.
All right, let's shift gears. Time for our This Is Not Financial Advices segment. Think of this as us pitching a maybe slightly out there but plausible trade idea to our internal committee based on everything we've just discussed.
Okay. My read here suggests an interesting, maybe bold, but potentially rewarding play. Given the strong operational performance, that clear path for the transactional flywheel, and crucially, the pending ProCap BTC de-SPAC, where Cohen retains those 2.1 million founder shares, I'm proposing a speculative long position on COHN, the ticker, into year-end. We're essentially betting on a significant re-rating event. This isn't just your average capital markets firm anymore. It's becoming a hybrid. Yeah, a traditional investment bank that's about to get significant direct exposure to a Bitcoin-native financial services firm, potentially holding up to $1 billion in Bitcoin. That subdued volume on earnings day, I don't see that as lack of interest. I see it as thin liquidity. And for the savvy investor, that thin liquidity can create an asymmetric opportunity, a chance for a sharp re-rating, especially as we get closer to that year-end de-SPAC closing. The market, in my opinion, just hasn't fully priced in the potential crypto premium this firm is about to inherit. We're looking for a revaluation to reflect this new hybrid identity. It's really a bet on the market catching up to the strategic transformation that's already well underway.
That is a bold call. I definitely see the crypto premium logic. But okay, committee challenge time, playing devil's advocate again. We're talking a microcap, highly exposed, even indirectly, to the notoriously volatile crypto market via ProCap BTC. What if Bitcoin corrects sharply? Or regulators crack down harder? How do you weigh those very real downside risks? And are we sure this thin liquidity isn't just, well, a lack of sustained institutional interest that could keep the valuation capped, regardless of the assets?
Critical counterpoints, absolutely. And we have to acknowledge them. Bitcoin volatility, given.
Yeah.
Regulatory uncertainty, always there. But my conviction comes from a few things. One, Cohen isn't just buying Bitcoin passively, they're embedding themselves in a Bitcoin native financial services firm. That suggests a more robust business model, not just speculation. Two, those founder shares give them a lower cost basis and significant upside leverage if this transformation works. And three, regarding liquidity, yes, it's thin now. But the de-SPAC closing, ProCap Financial Inc., operating with that potential billion-dollar Bitcoin balance sheet, that itself could be the catalyst. That event could force the market to reevaluate and potentially attract new institutional interest, improving liquidity over time. It is definitely a calculated risk, betting on a transformation the market hasn't fully priced. The risk is certainly elevated, but the potential reward for being early to this re-rating event could be, I think, disproportionately higher.
Okay, so to recap this deep dive, Cohen Company delivered a truly standout Q2 2025, driven by exceptional performance from Cohen Company Capital Markets, that investment banking arm, and fueled by a strategically expanding SPAC ecosystem, most notably with that pending ProCap BTC merger. They've shown commitment to shareholder returns, disciplined capital management, all while navigating, a complex and fast-evolving market.
Indeed. It really is a fascinating case study. A financial services firm actively transforming, diversifying its revenue, with this potential kicker from founder shares riding a whole new wave of growth via crypto. So the big question left for you, the astute investor, is this. How much of a valuation premium should the market ultimately assign to a traditional investment bank that's now poised to have significant direct exposure to a Bitcoin native entity holding substantial crypto assets? What will that unique hybrid identity truly be worth in the end?
Thank you for tuning into the deep dive. We really hope this exploration into Cohen Company's earnings has given you some valuable insights to think about. We look forward to our next dive.